In this lesson, we'll talk about the time value of money application in bond and stock valuation. After this lesson, you should be able to explain the key features of bonds and conduct bond valuation for bonds. And we also will try to estimate bond yields, including yield to maturity, yield to call, current yield, and capital gain yield. We'll try to explain the main determinants of market interest rates. Then we'll try to apply the dividend growth model to estimate stock prices and explain how to use price multiples to estimate stock prices, and then explain why stock prices can be volatile. So overall, this lesson is built upon the last lecture. We explain how to apply the time value of money concept and techniques in basic bond and stock valuation. Bonds and stocks are major financial securities in the financial market, and they are major ways of financing for corporations. Therefore, understanding the risks and returns in bonds and stocks help us to understand the cost of debt financing and cost of equity financing in corporations. The valuation process introduced in this lecture will also be applied later to estimate the value of a company. So the first thing we need to know about bonds are that bonds are debt securities. Bond issuers are borrowers and holders are creditors. The key provisions for a bond are outlined in the indenture of a bond, which essentially is a contract between the issuer and the bondholder. The indenture describes terms such as the coupon rate, maturity date, and par value. Par value is the face amount of the bond. It is a principal repaid at maturity. Typically, the par value is $1,000 per unit of the bond. Coupon interest rate is the stated interest rate. So interest is usually paid semi-annually. This coupon interest rate can be zero. You multiply the coupon interest rate by the par value to get the dollar amount of interest payments. These interest payments are called the coupon payments. Maturity is the number of years until bond must be repaid. Issue date is the date when bonds were issued. Default risk is the risk that issuers will not make interest or principal payment. On the next slide, you have information about bond issued by AT&T. So we'll try to identify some key information about this bond. So let's take a look. This is a bond that was issued on February 3rd, 2009 and will mature on February 15th of 2019, so it has a maturity of 10 years. So this is the maturity date and issue date. So 10-year maturity. Its coupon interest rate is 5.8% and it pays coupon payment semi-annually, or say every 6 months. The first coupon payment was paid on August 15th of 2009, which is 6 months after the bond was issued. With a par value of $1,000, we can calculate the amount of each coupon payment. It is $1,000 multiplied by 5.8% and then divided by 2, so $29 every 6 months. So coupon interest rate 5.8% with a par value of $1,000, that means $29 every 6 months. The Fitch rating A is about the bond's default risk. A rating of A suggests the bond is fairly safe, or say low risk. So here's the information about the bond credit rating. In the United States, bonds can be classified into the following three types according to who issues the bond. Treasury bonds are issued by the Department of the Treasury. Municipal bonds are issued by city or other local governments or their agencies. Corporate bonds are issued by corporations. U.S. Treasury bonds are backed by the full faith and credit of the U.S. federal government. They are usually considered the safest investment in the world. Depending on the different maturities, Treasury bonds can be classified as Treasury bills, which have maturity less than 1 year, and then Treasury notes, which have maturity generally 1 to 10 years. Treasury bonds, which have maturity greater than 10 years, usually 10 to 30 years. Treasury bills are quoted for purchase and sale in the secondary market on an annualized discount percentage or basis. For example, if a T-bill with $10,000 par value has a bid quoted of 0.05 and it has 16 days remaining to maturity. This means the price is at a discount from the par value of 0.05% multiplied by 30 days out of 360, which is 0.005%. Therefore, the price is the $10,000 par value multiplied by 1 minus 0.005%, which gives you 99.5. Treasury notes and bonds both have coupon payments every 6 months. Treasury notes have denominations of $1,000 per bond, and denominations for Treasury bonds range from 1,000 to 1 million. The 10-year Treasury note has become the most frequently quoted security when we discuss the performance of the U.S. government bond market. Its yield is used to convey the market take on the long-term macroeconomic expectations. Treasury notes and bonds are quoted in 32%. So, for example, for a Treasury bond quoted 105 column 19, that is 105 and 19 out of 32%, or say 105.594% of the par. This translates into a dollar price of $1,055.94. So this is assuming bond par value of $1,000. Corporate bonds are bonds issued by corporations. Some corporate bonds come with different provisions. For example, callable bonds can be purchased before the maturity date. So if the company decides to call back the bonds, with these callable bonds, they can be called back before the bond matures. Convertible bonds can be exchanged for shares of the firm's common stock, or say we can convert those bonds into common stocks. Putable bonds give the bondholders the option to retire or extend the bond. Floating rate bonds have adjustable coupon interest rates. The value of a financial security should be based on the present value of all the cash flows this security is expected to bring in the future. So if you remember the timeline from last lecture, suppose we have CF1, CF2 till CFN in year 1, year 2, and later years. Then the present value of all those cash flows is the total present value of all the future cash flows. If we apply this principle to a bond, for example, a 10-year 10% coupon bond, how do we calculate the value of this bond if we assume a discount rate of 10%? To answer this question, we first need to understand what kind of cash flows would this bond bring. Or say if you are the investor and you buy this bond, what would this bond bring to you? What kind of money would you make out of this bond? There will be 10 coupon payments, each payment being $100, which is $1,000 par value multiplied by the 10% coupon interest rate. By the end of the 10th year, which is at the bond maturity, there will be a one-time lump sum payment of $1,000, which is the par value, or say the principal payment. So the timeline of cash flows from the bond is shown on the next slide. We have 100, 100, 100, there are 10 of them. And then by the end of the last year, we have another lump sum payment of $1,000. This $1,000 doesn't appear in the previous years, so it's only here by the end of the maturity. So if we apply the valuation principle, we try to calculate the value of the bond. It is all these future cash flows discounted by the 10% discount rate, and we sum them up, and the result is $1,000. So that is the value of the bond according to a 10% discount rate. We can use the financial calculator to get the result. Think of this bond as an annuity of coupon payments. It is an annuity because all those coupon payments are the same amount, plus a lump sum of the principal payment and maturity. So we can enter values for both payment and future value. We have 10 payments, each payment being $100, and we have $1,000 lump sum amount at the end, so we put 1,000 FV, and we use 10% discount rate, so 10 as IY. We compute present value and we get $1,000. That's the value of the bond. The discount rate is subject to the change of the current market interest rate. So, for example, if expectation rose by 3%, then the discount rate could be 13%. And if we use 13% as the discount rate and everything else remains the same, then we would have a price of $837.21. So you get the idea. When the interest rate rises, then the bond value would fall. So when the interest rate goes above the coupon interest rate, the bond value falls below the par value, and in that case we say it sells at a discount. On the other hand, if inflation fell and the interest rate declines to 7%, so we can use 7% as IY, and we calculate present value, and it turns out to be $1,210 plus 71 cents. So in this case, when coupon interest rate of 10% greater than the 7% interest rate, or say discount rate, then the price of the bond will rise above the par, and in that case the bond sells at a premium. What happens to bond value over time if the required rate of return remain at 10% or at 13% or 7%? So you can use a previous example and try to recalculate the bond prices with different years remaining to maturity. You simply only need to change the M from 30 to, for example, 25, and then 15, or 10, or 5, or 0. The result shows that as the bond approaches its maturity, the price will change. So, for example, when the interest rate is 7%, a 30-year bond starts with a price of $13.72. That's the result you can get when n equals to 30. But then when n equals to 10, the price becomes $12.11. And you can also try when n equals to 0. That's when the bond hits maturity and the price is 1,000. When the discount rate is 13%, or say when you use 13 as IY and n as 30, the 30-year bond price actually starts with $7.75. As time goes by, the price actually would go up. So 20 years later, its price can become $8.37, and when the bond approaches its maturity, the price can be $1,000. So the conclusion is, at maturity, the value of any bond equals its par value. The value of a premium bond would decrease to $1,000, and the value of a discount bond would increase to $1,000. And a par bond, or say a bond that sells at its par value, can stay at $1,000, the par value, if the interest rate remains constant. Now let's talk about return from the bond investment. This is the concept of yield to maturity. Yield to maturity is the rate of return earned on a bond held to maturity, and this is also called the promised yield. So it assumes the bond will not default, and therefore the investors can hold the bond till maturity. And imagine you pay the market price to buy a bond, and you hold the bond for several years until the bond matures. Then you are concerned with the question that every year, what is the return you can realize? So that is the concept of yield to maturity. To find yield to maturity, the calculation is illustrated by the example on the next slide. So the question here is, what would be the yield to maturity on the 10-year 9% annual coupon bond that is selling for $887? So imagine you are the investor. You are paying $887 to buy the bond, and you will hold it for 10 years. And every year in the next 10 years, you will receive $90 as coupon payment. And then by the end of the 10th year, you will receive a lump sum payment of $1,000. So compare what you have to pay, which is $887, and what you can receive, which is the 10-year annuity plus a $1,000 par value payment. What is your rate of return every year for the next 10 years? Mathematically, we're actually trying to find the discount rate that works, or say that matches the total present value of all your future payments from the bond with your present value of $887. So the value of the bond, $887, should be based on all the future payments discounted by a proper discount rate. So we are solving for the ID here. And solving for this ID from this equation can be somehow difficult, but we can get some help from the financial calculator. So what you can do is to input the price, $887, as a negative number into present value. Remember, this is how much you have to pay. And then as what you can receive, which is cash inflow, you have $90 each time for 10 times. And by the end of the 10th year, you have another $1,000. So you put this $1,000 as future value. And then you compute for the IY. It turns out IY is 10.91. That means every year on average, you are getting a return of 10.91%. What if you have to pay a higher price, which is 1134.2? Then you put this 1134.2 negative number as PV. Everything else remains the same. You compute for IY. The IY is 7.08. So apparently, if you have to pay a high price, then your return every year is lower. For another calculation, if the price were 940.20, so we then use 940.20 as PV, and everything else keep the same. We compute for the IY, turns out to be 9.97. So this is a bond that's selling at discount. If you pay a low price to buy this bond, then your return would be higher. And in that case, our return 9.97 is actually higher than the coupon interest rate. We can think of the yield to maturity, or say the return of our bond investment, as a sum of two components, current yield and capital gain yield. Current yield is the annual coupon payment amount divided by the price. So current yield looks at the current price of the bond and represents the return an investor would expect from the coupon payment if he or she purchased the bond at the current price. This actually is not an accurate reflection of the actual return that investor would receive in all cases, because bond prices are constantly changing due to market factors. To reflect the return due to the change in bond price, we have the capital gain yield. The capital gain yield is the capital gain, which is the change in price, divided by the beginning price. The expected total return from the bond investment, which is the yield to maturity, equals to the expected current yield plus the expected capital gain yield. So for example, for a 9% coupon 10-year bond, the price is $887, yield to maturity is 10.91%. We can calculate the current yield, which is the coupon payment divided by the price, so that's about 10.15%. Then we can see the capital gain yield is the difference between the yield to maturity and the current yield, so that is 0.76%. That gives you the idea that the bond price is expected to rise a little bit, not much, but 0.76% over the next year. You can also calculate this capital gain yield by calculating the bond price in year 1, and find out the difference between bond price in year 0 and year 1, and divide this difference by the price in year 0, which is the $887. So then you will get the same answer, which is 0.76%. We'll take a look at example 5-10 at the end of chapter 5. This is page 227 in your textbook. The Brownstone Corp's bond have 5 years remaining maturity. Interest is paid annually, and the bond has a 1,000 par value, and the coupon interest rate is 9%. So the question is, what is the yield to maturity at the current price of $829 or $1104? So we'll take a look at the case, the yield to maturity when the price is 8.29 first. When the price is 8.29, we can input into your financial calculator 5 as N, price as a negative 8.29, and a payment of $90 per year, and future value 1,000. We can compute IY, and you get IY result as 13.98. So that means the yield to maturity is 13.98%. Then when the price is 11.04, you just change the PV from negative 8.29 to negative 11.04. You compute IY, and you get IY as 6.5. So that is a yield to maturity of 6.5%. Part B of this question says, would you pay 8.29 for the bond if you thought that the appropriate rate of interest was 12%? So the answer is yes, because at a price of 8.29, the yield to maturity is 13.98%. And this is greater than your required rate of return of 12%. Let's also add a part C, which is not in your book. What is the current yield of the bond if the price is 8.29? We can calculate the current yield as a coupon payment amount divided by the current price. So that's 90 divided by 8.29. So that's 10.86%. So again, current yield measures the return from coupon payment, but this is not a comprehensive measure about the annual return from the bond investment because it does not account for the potential increase or decrease in the bond price. So far we talked about price and yield to maturity for annual coupon bonds. In reality, actually most of the bonds pay the coupon payment semi-annually. So for semi-annual coupon bonds, we only need to make some simple adjustments. We multiply the years by 2 to get the number of payments. So 2 multiplied by n. That's how many coupon payments you are getting in all those years. And then you divide the nominal interest rate by 2 to get the semi-annual interest rate. And you divide the annual coupon payment by 2 to get the semi-annual payment. So your annual coupon rates multiplied by 1,000 and then divided by 2, you get the coupon payment amount every 6 months. Your future value amount, that is the $1,000 par value payment, and this will not change. And then you compute for the price, the present value. So for example, if we want to calculate the value of a 10-year 10% coupon semi-annual bond, if the discount rate is 13%, then 10-year, that means 20 coupon payments because there are 2 payments each year. Each payment is $50, which is 1,000 multiplied by 10% and then divided by 2. Future value remains 1,000. And here, for the semi-annual interest rate, you're using 13 divided by 2. So 6.5 as IY. You compute for the price, for the present value, 834.72. Now let me show you in Excel how to use the PV function to compute the bond price. So for example, if we are looking at a bond with 10-year maturity and 13% coupon rate, and a par value of 1,000. So I simply type in equals to PV, and our rate is 10%, and 10 payments, each payment being 130, and our future value, or say the final par value, is 1,000. So the price is 1184.34. And another way in Excel is to look it up from the formulas, search for the function library, and here type in PV from all formulas. So we search for the PV function, and this is what we find. And then we just start typing in a rate of 10%, 10 payments, each payment with 130. Future value is 1,000. And you can ignore the type and simply say OK. and the result is also 1184.34. So you can use the built-in functions from the function library and look for the PV functions. If you check out the Excel file that I posted on D2L, which is the Chapter 5 mini case Excel, you can also find details in bond valuation with Excel.